That is the closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves, get you up to speed on the action from today's trade. Sylvia Jablonski, Defiance ETF's CEO and CIO, as well as Yahoo Finance's Jared Blikre, joining us here to break down the moves today. Jared, my friend, let's start with you on that close.
Well, we had a photo finish for the Dow. I'll show you. We managed to close up 10 points. I think investors will take that. If you're looking at the Nasdaq, we'll get to that in a second, but the Dow up about 2 basis points on the day, and you can see it just barely climbed into the green in the very final minutes here. Nasdaq Composite, a different story. Worst day for the Nasdaq, the S&P, and the Nasdaq 100 here since August 1st, and you can see the composite down about 1.5 percentage points. S&P 500, not too bad, down 0.6%, but you can see it was down in the red most of the afternoon, deep in the red there. And then we'll also show the small caps. S&P 600 managed to eke out a close, a positive close as well. I don't do this often, but I'm going to show you the Dow Jones Transportation Average. So this is the stuff, the stocks that ship the stuff. They were up 1.5%. So basically the amount that the Nasdaq lost. So interesting day of bifurcation here. Some big winners, some big losers. And when we look at the S&P 500 sectors, we can see that playing out here. Real estate was up 1.81%. We saw a drop in long-term interest rates that helped that move, but we also saw staples up 1%. Utilities also up nearly 1%. Healthcare up a fraction of that, and also materials. Then tech, as I said an hour ago, that was the only underperformer of the day next to the S&P 500. And if we take a look at the Nasdaq 100, you see a lot of red, but it's mainly concentrated in some of those bigger issues and also a lot of those higher momentum issues that have been doing well recently, like Palantir, which is down 9.35% today. If we take a look at the Dow, we also see a lot of red, but more green than I think on a percentage basis than we see in the Nasdaq 100. Home Depot, that earnings story up 3%, although Boeing down 3%. So some winners, some losers there. And I'm going to just do a deep dive inside of tech real quickly. Here's what we're seeing in software. Oracle led the way down 6%. It was one of those recent high flyers. And then here are the semiconductors. And here we see a lot more deep red. NVIDIA, Broadcom, Taiwan Semi, AMD, all down more than 3%. So is ARM, by the way, and Marvell. Finally, a look at smaller disruptive tech. And aside from Tesla, we do see a lot of these names in deep red as well. So a lot of the fringier parts of the market and also some of the mainstream parts of the market that have done well recently got rotated out and just didn't do as well today.
All right, thank you, Jared. Sylvia, your take on today's trade, what'd you make of it?
Yeah, I think that it's a little bit of par for the course in terms of the market was right for a pullback, right? But today was actually the worst pullback that we've had since April, or second worst, I should say, since April. You know, between the Liberation Day positioning and yesterday, Mag 7 had rallied about 40%, right? And so I think a pullback is reasonable, and I don't think we should worry about it so much. It's also healthy for markets. So I'm not too worried about it today, but I do think that we're priced for perfection. And so in terms of the long-term run-up, you know, that remains to be seen, kind of how much further could we go from the average levels that we were at the last couple of weeks.
I've had plenty of strategists, by the way, come on and say they think we're due for a broader pullback.
Yeah, I think so.
That makes sense to you. How do you think, let's say we see that pullback, how do you think investors respond to that? Is it just, hey, they jump right back in? What do you think?
Well, I think what investors do will dictate what happens in the second half of the year, right? So we saw some of the biggest names have pullbacks today. We talked about Palantir today. We talked about NVIDIA. These have really been the classic darlings that people have been pouring into. And so now that you have these names pulling back, particularly Palantir, if we see the buying on the dip come into play tomorrow and over the next couple of days and you know, go back to status quo, then that tells me that, you know, investors are pretty bullish for the second half of the year on these names. If we don't see that and we kind of see continued momentum to the downside, then perhaps we'll have to reevaluate there and see if there will be, you know, kind of more diversification across breadth within.
Is it fair to say, correct me if I'm mischaracterizing, that even if we saw some near-term chop,
yes,
you sound generally constructive looking at earnings, the economy? Is that fair?
Yeah, I think for me, the issues that concern me are broader based issues. They're things like geopolitics, they're things like tariffs. I mean, the earnings, we talked about it before, earnings season was really good, right? You had the highest percentage of names beating on EPS, beating on revenues. We're talking about 80% of the companies reported on both of those numbers. CapEx is very strong, buybacks are strong, macroeconomic data is strong. It's softening a little bit, but it still remains in a good spot. And so that soft landing has come, corporations are strong. And so I think it's going to take kind of a bigger event to see a massive pullback. But that being said, you know, pullbacks of 2%, 5%, 10%, they happen throughout the year, even in the best of markets. So par for the course.
Sylvia, always great to see you, especially on set. Thanks for joining us.
Thank you.
Well, a broad decline in tech stocks weighing on the Nasdaq as it sees its worst day since August 1st. Investors keeping an eye out for signs of a tariff-induced stress amid a cloudy path to an interest rate cut. For more on the market action, let's get to Cross-Market Global Investment Chief Market Strategist Victoria Fernandez. Victoria, good to see you as always. I'd love to just get your take on what we saw today, Victoria, as my buddy Jared Blikre is pointing out. Looking at the tape here, is a photo finish for the Dow. Nasdaq, though, we are in the red, finishes down about 1.5%. Tech did taking a hit. I'm just curious what you made of today's trade.
Yeah, you're right. When we look at the tech trade, that's obviously where we were seeing some of that rotation. But I think it's interesting to look and see some of the sectors that actually were doing better. It's a little bit of those defensive sectors. Staples were doing better. Utilities are doing better, maybe because there's the anticipation of rates coming lower. And so utilities would benefit from that. So there were some sectors that maybe tell you people are looking for areas in the market to invest outside of tech, taking a little bit of the profit off the table that they've had. And there's nothing wrong with that. And it's probably a little bit of investors thinking we've been hearing about a slowdown, not a recession, but maybe this is time that we're starting to see that. And so again, taking some chips off the table and maybe repositioning for a little bit of a slowdown.
We had strategists on the show today, Victoria. I would say, kind of generally long-term constructive. Their argument being, hey, as they see earnings solid, economy still looks resilient. Do you share that view?
I share it to an extent where the market really seems to be looking through some of the weaker economic data that we've received as of late over the last couple of weeks. And they're really looking at, okay, we've got a Fed that will probably lower rates going forward, maybe twice this year. You've got recession odds coming down. You have this AI boom that continues, even though we've seen tech come down, that's still that secular push driving the market. Productivity is higher. And now we have this benefit from the bill that was passed of expensing and some deregulation. These are all very positive for the market on the longer term. So I think that's what people are looking at. But I do think we have to be a little wary. Earnings have been holding up this market. But if we start to see margins compress a little bit from higher prices, PPI was, maybe the first little leg of us seeing some prices go higher, then I think we have to be concerned that, again, we have a little bit of a slowdown, consumers pull back, wages start to mitigate a little bit, and we'll just have to work our way through that. But longer term, I think we're in a pretty good position. Let
me ask you, Victoria, because you mentioned the Fed. So Jay Powell, Jackson Hole, Friday, we all seem very wound up about this. I'm just curious what you expect to hear from Powell, Victoria, on Friday. Is it neutral Powell? Is it dovish Jay, hawkish Jay? What do you think?
I don't expect to hear too much from Powell. I think he will try to lay the groundwork a little bit for what the market has already priced in. Last time I looked, we're 86% of a 25 basis point cut. When probabilities get that high, the Fed doesn't want to disappoint the market. So I think he'll lay the groundwork for that, and people expect that. Beyond there, if he remains a little bit hawkish, talking about concerns with the inflation that are there, wanting to maybe get more data before they make another decision, then the market might react a little bit negatively to that, being concerned that that more hawkish Powell will take over, and maybe we only get one cut this year. We just don't know what side of the coin he's going to land on, whether he's going to have a dovish or hawkish sentiment. But I think the major thing is he'll probably just lay that groundwork for the first cut.
Victoria, I know we're focused on Powell on Friday, and for good reason. Listen, you could see some chops and volatility. But should we be focused on that as long-term investors, or the fact that, listen, his term ends next spring, there'll be a new Fed head. You can bet whoever that Fed chief is, there's 11 candidates right now, right? That person's views are going to dovetail with the president's. Cuts are coming. Is that what we should be focused on instead?
I think that's probably the broader picture that we should look at. What does the timing of that look like? How quickly are they going to move? Or are we going to actually stay higher for longer and wait and have those cuts later into 2026? That's the focus that people are looking at. I think with Jay Powell, they assumed the higher for longer. Now that we'll probably have a new Fed chair coming in, or we will have a new Fed chair coming in, the timing of that could change. And that probably could boost markets as long as we are lowering rates for the right reasons. If it's because we're concerned about growth and we're concerned about earnings, then that will be a drag on the markets.
All right, we talked big picture, Victoria. Let's end here on some picks, some specific names. Why is Citi a name to own, in your opinion?
Yeah, so we like financials. We have liked financials for quite a while here. A steepening of the yield curve is obviously going to be beneficial. Their balance sheets are really strong. We've always loved some of the biggest names like the JP Morgan and the Goldman Sachs, but they're trading at like 15 times next 12-month earnings. You look at Citi, you're getting that same benefit of a strong balance sheet. You're getting the same benefits of a dividend, but you're paying less. You're getting 10 times. So it's a better valuation. And I think financials are going to continue to be strong sectors in this market. They have an uptrend right now, and it looks like it will continue, especially with the steepening of the yield curve.
Final pick, Victoria. Snap on, you say it's a buy. What's going to move this one higher?
I do. I think we look at some of the benefits coming out of our one big beautiful bill, right? We talked a little bit about the expensing and the deregulation from there. Snap and industrials should benefit from that. So Snap-on is that industrial name. They are headquartered here in Wisconsin. They develop most of their and manufacture most of their items here in the U.S., so they won't be subject to tariffs as much. And you're looking at a company that has over 50% gross margins for the last 5 years and a 2.6% dividend. So I think you can have that industrial name in your portfolio, and it'll have a little upside over the next year.
Victoria, thanks as always for your time, those picks. Appreciate it.
Pleasure, Josh.
The Port of Los Angeles, the busiest container port in North America, had a record-breaking July, moving over 1 million containers in 1 month. Into August, the port has processed 5% more cargo than at the same point just last year. Joining me now is Gene Soroka, Port of Los Angeles Executive Director. Gene, it's always great to see you. So a record-breaking July, Gene. Walk us through that. What drove that?
Good afternoon, Josh. It has been an unbelievable roller coaster of a ride, and it's not over yet. What we've seen is that when hard trade policy goes into effect, the cargo declines rapidly. Then when those policies are eased and deadlines extended, the cargo picks up one more time. So many were looking at the July 8th deadline. Then it was the August 1st, then August 7th, and August 11th with respect to China. So importers were just trying to get in under the wire, and did they? Best month ever in the history of the Port of Los Angeles. And to me, the telling statistic was not one ship backed up.
What was coming in, Gene? I mean, broadly in terms of categories, was it furniture? Was it electronics? What did you see?
Finished goods and parts for American factories almost equal. On the finished goods side, furniture, clothing, footwear, electronics, and toys leading up to the all-important holiday season. On the parts side of the business, a wide scale, but especially focused on the automotive tiered suppliers.
And now the question is, what do you see ahead? What do you forecast? What do you estimate?
August does not look bad. We may come in between 900 and 950,000 container units. That would represent a 7 to 10% drop compared to July. So we're not falling precipitously, but a noticeable decline. And we probably will look back and say July was our peak, which if in fact it is, a little bit earlier than normal. After that, we're going to see decline simply because the year-on-year comps were so high, and the fact that we've got so much inventory now in the country.
Based on what you're seeing at your port, Gene, add it up to us. What does this all mean for the American consumer?
It's going to be interesting because most importers continue to tell me that their prices have risen dramatically. Anywhere from 15 to 55% tariffs now exist, depending on where you're shipping from. But realistically, the big box retailers, home improvement stores, were able to pad their inventories for months on end. They're going to burn through that stock eventually. It's the small to middle-sized importers that are dipping into cash reserves in order to buy and pay those exorbitant taxes or tariffs once the cargo lands here in ports like Los Angeles. They're going to have to pass on those costs at some point, and that may be very soon.
Let me ask you, Gene, because listen, we're all trying to figure out on this show how big a deal we think tariffs are going to be ultimately for companies. You know, we did speak recently with Jerry Storch, the CEO of Storch Advisors, and it was interesting because he doesn't see tariff impact as necessarily a big deal. Just take a listen, and then I want to get your reaction on the other side.
I think that the impact has been overblown. People have worried about it too much. And I'll point out, we haven't seen it yet. And I understand what everyone's saying. Oh, it's coming, it's coming. You know, the goods that come in for the fall, they're going to be the one that show all the tariffs. But just keep in mind, a lot of the products aren't imported at all and don't have any tariffs on it. I don't think we're going to see some kind of big explosion here, you know, on the net downside in terms of operating results.
Gene, what do you make of Jerry's comments there?
Well, I think we should point Jerry to Detroit and have him speak to General Motors and the Ford Motor Company after their quarterly results. On the consumer side, we've seen the bigger companies absorb a lot of these costs as well. They're going to have to start passing them on just a little bit. Explosion? No, but we'll see a noticeable uptick in the price online as well as at the store shelves.
Gene, I want to talk China before I let you go here. I'm curious, what percent does China now represent of your business, Gene, versus, let's say, 5 years ago, 10 years ago?
That's a good question, Josh. We're at about 45% and declining. Our entire business portfolio made up of China imports and exports. It was 60% dating back to 2018. We've seen a strong shift in sourcing and manufacturing to Southeast Asia, locations like Vietnam, Indonesia, Malaysia, and that will continue based on the merchandisers and importers we talk to on a regular basis. Big change.
Final question, Gene. A big reason President Trump is imposing these tariffs is because he wants more stuff made here, right? Long term, let's say that happens, Gene. I'm curious how well your port is positioned and would be positioned to handle that.
A couple things we have to look at. One, if manufacturing is to come here, we need a sector-specific review. According to the National Association of Manufacturers, we still have 414,000 manufacturing jobs open today. We've got to work on that, the talent and the geography. But let's say this all works. There'll be more exports, and these companies will try to find new markets. We'll be ready here in Los Angeles. Every 4 containers create a job, regardless of which direction. We'll be ready here.
Gene, always great to see you and to have you on the show. Thank you. Time now for what to watch Wednesday, August 20th. We're going to start off on the earnings front. More reports from the retail sector coming in on Wednesday, including TJX, Lowe's, and Target. Lowe's announcing results for the second quarter before the markets open. Analysts expecting same-store sales to rise about 1% in Q2. It's coming after rival home improvement retailer Home Depot reported earnings on Tuesday, maintaining its full-year forecast amid an improving rate environment. Taking a look at the Federal Reserve, we're going to be getting some more commentary from a couple Fed officials on Wednesday. This is coming after comments from Fed Vice Chair for Supervision Michelle Bowman on Tuesday. Bloomberg asking Bowman about her interest in taking on the role of Fed Chair, and Bowman deflecting, saying, quote, "I'm really focused on the job that I'm doing." And sticking with the central bank, the Fed releasing minutes for July's FOMC meeting, where the central bank held interest rates steady. The minutes giving us more insight into a divided Fed's thinking as it prepares for its next meeting on interest rates in September. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.